Although the history of the foreign exchange dates back uh, to the ancient Babylonians, the history that concerns today's Forex trader should only need to be traced back as far as the mid-1930s. At that time, London became the leading center for foreign exchange. The British pound served as the most traded international currency and as the reserve currency of most nations. However, the end of World War II changed the world's financial situation. The British, Japanese, German, and nearly all other European economies and industrial production capabilities were almost completely destroyed. The USA emerged from the war as the only major participant unscarred. In an attempt to avoid the same devastating economic conditions that resulted from post-war policies after World War I, representatives from 45 nations met in Bretton Woods, Pennsylvania in the summer of 1944. The International Monetary Fund, otherwise known as the IMF, was the result of this meeting. Basically, in an attempt to help struggling world economies repair themselves, currencies were fixed in an exchange rate system that tolerated 1% currency fluctuations to gold values. In turn, the US dollar was pegged to gold at $35 per ounce. As a result, the US dollar became the reserve currency for all rebuilding capitalist countries, and all currencies were pegged to the US dollar. For nearly 30 years, this protected global market allowed currencies torn by the ravages of war to rebuild their economies. However, near the end of the 1970s, with most of the participating countries' industrial might rebuilt, the pegging of currencies against the US dollar actually prevented nations from improving their global economic standing. In 1973, under the leadership of President Richard M. Nixon, the United States officially abandoned the gold standard as the basis for the US dollar value, which effectively nullified the Bretton Woods Accord. Shortly thereafter, a free-floating system of international currency exchange rates was officially mandated by the IMF, which led to the formation of the modern foreign exchange market, wherein central banks exchange currencies among themselves, but only in lots of $1 million. Because of this lot size, this made trading the Forex spot market the exclusive playground of international banks and corporate financial institutions. However, in 1998, fueled by the Commodities Futures Modernization Act in the United States and the development of internet dealing systems, now basically anyone can trade currencies in the Forex spot market. Over the years, the foreign exchange market has experienced spectacular growth. A daily average volume in 1977 was US 5 billion, 600 billion in 1987, reached the trillion mark in September 1992, and now averages between 1.5 and 2.5 trillion dollars on any given day. As we can see, the foreign exchange market is an amazing market, no other like it in the world. It's exciting. I'm glad that you have taken this opportunity to become involved. That is an excellent little recap of the history of the market. We're going to learn a lot. This is an exciting, fascinating market with a great history, and it's only going to get better from here, especially for those like you and me who have become involved at this stage, the present time. There's no better time than the present to become involved in this market.